If you study basic macroeconomics, you might notice something strange. Accounting for inflation, over the long run, US stock market returns are, on average, about 7% per year, while US GDP only grows at about 3% per year. Intuitively, this seems off. GDP, or gross domestic product, is defined as the total value of goods produced and services provided in a country during 1 year. So, if a stock represents a portion of a business, this means that the value of businesses grows faster than the overall economy. Does this mean the stock market is a massively overpriced bubble? It turns out that there is an intuitive reason behind this disparity. To clear things up, let's use an example. Assume an economy with zero inflation, and imagine a hypothetical company with zero expenses that earns a profit every year of $1 billion. This $1 billion is what the company contributes to GDP, because this is the value of the goods produced or services provided by the company in a year. Since this number does not grow year after year, the GDP growth contributed by this company is zero. And yet the company generates a large profit, which it can either return to shareholders every year to give them a return in the form of a dividend, or it can hold on to that money, in which case the value of the company's assets increases, so its stock appreciates. Note that calculated typical stock market returns account for reinvesting any dividends. Admittedly, this hypothetical company is unrealistic, but it gives a sense of why stocks and GDP grow differently. If all corporate revenue stops growing, GDP will remain constant, but companies can still make a profit, leading to dividends or increased share prices. For a nice analogy, you can think of renting out a house. Even if the price of the house you're renting out stays the same, and the rent you collect stays the same, you are making returns since you are being paid the rent, so your net worth is increasing. Just as constant real estate prices don't mean that you don't make money or increase your net worth, a constant GDP does not mean that there is no stock market return. Now, this intuition breaks down to some extent if you consider a company that reinvests all of its profits into the business to increase future profits. This company will likely make larger future contributions to GDP than a company that holds onto all of its profits as cash. But one can imagine that shareholders would value a stock a whole lot more if there were expectations of significantly increased profit in the future. This means that though this sort of company does increase its contributions to GDP over time, its stock price likely grows even more as the company shows that it can sustain growth. The reality is that most companies lie somewhere on a spectrum where they give some of their profits to shareholders directly through dividends, hold some in cash or treasuries, and reinvest some back into the business. It is most clear as to why GDP growth and stock returns are different when we consider the edge case, a company that profits the same amount every year and either returns this in the form of a dividend or holds onto this as cash. This demonstrates how it is often helpful to consider an edge case and reason from there to solve problems. To summarize, the insight here derives from the fact that constant profit does not mean that a company isn't generating value and positive returns for shareholders. Increasing profit just means even more value and returns for shareholders. Note that while profit is not a direct measure of GDP contribution, it does convey the general intuition here. Of course, there are many reasons why GDP does not correspond exactly with stock prices, but what I have explained here is an important and elegant factor. The implication of the disparity in growth between the stock market and GDP is that it is critical for everyone, not just the rich, to invest in assets like stocks, instead of only passively participating in the economy by earning a salary. Otherwise, we can expect wealth inequality to continue to increase.